In 1637, a single tulip bulb sold for more than a skilled craftsman earned in a year. Then, almost overnight, it was worth nothing. 300 years later, dot-com companies with no revenue and no product were worth billions. Then, almost overnight, they were worth nothing. In 2021, digital images of cartoon monkeys sold for hundreds of thousands of dollars. Then, almost overnight, they were worth nothing. Same story, different asset, every single time. What if financial bubbles are not accidents? What if they follow a precise script with 5 distinct acts that plays out the same way every century, in every country, across every type of asset? Because they do, and once you see the pattern, you cannot unsee it. The man who first mapped this script was a 20th century economist named Hyman Minsky. He spent his career studying financial crises and came to a conclusion that most of his colleagues found uncomfortable. Instability is not an aberration in capitalism. It is a feature. Stable economies breed risk-taking. Risk-taking breeds excess. Excess breeds collapse, and then the whole cycle begins again. Minsky identified 5 stages. Every bubble in history, from 17th century tulips to 21st century cryptocurrency, follows them in order. The names of the assets change. The stage directions do not. Stage 1 is displacement. Something changes in the world. It might be a new technology that genuinely works. It might be a policy shift that opens a new market. It might be a discovery, an invention, or a sudden drop in interest rates that makes borrowing cheap. Whatever it is, it creates a real opportunity. Early investors notice. They move in quietly before the crowd arrives, and they are right to do so. The opportunity is genuine. This is the spark. The dot-com era began here. The internet was real. The ability to connect millions of people and move information instantly was a genuine revolution. The early investors who bought into the infrastructure of the web itself were not fools. They were right. The displacement was real. Stage 2 is the boom. Word spreads, success stories circulate, prices begin to rise. Rising prices attract more buyers. More buyers push prices higher still. A feedback loop forms. The rising price itself becomes the argument for buying. At this stage, something important shifts. The original buyers were buying the asset because of what it could do. The new buyers are buying because of what the price is doing. The reason for buying has quietly changed, but nobody has announced it. Stage 3 is euphoria. This is the stage where the normal rules of valuation are declared obsolete. Prices have risen so far above any historical measure of value that something has to give. Either the asset is wildly overvalued and due for a crash, or the old rules simply no longer apply. And in a euphoric market, the crowd almost always chooses the second explanation. New metrics are invented to justify the prices. Old wisdom is dismissed as out of touch. The people still warning about fundamentals are called dinosaurs. The people driving the price higher are called visionaries. This is also the stage where fraud quietly enters the picture. Not because the asset is fraudulent, but because euphoria creates exactly the conditions fraud needs. An audience that wants to believe, a pace too fast for scrutiny, and a social cost for asking inconvenient questions. Stage 4 is distress. Something cracks. It might be a single large company that posts unexpectedly bad results. It might be a regulatory announcement. It might be nothing more than the fact that there are no buyers left at the current price, and someone has to sell. The price drops. The drop attracts attention. People who were planning to hold begin to reconsider. Some sell. The price drops further. Here is where the feedback loop reverses. On the way up, rising prices attracted more buyers. On the way down, falling prices attract more sellers. The same mechanism that inflated the bubble now deflates it, but faster. Bubbles take years to inflate. They take months to collapse, sometimes weeks. At this stage, the smart money is already out. Not because they had perfect timing, but because they had already noticed the signs. The new metrics that replaced the old ones, the dismissal of historical comparisons, the stories that seemed too good, the valuations that required the future to be perfect, they sold into the euphoria. To the people still buying in stage 3, they looked like fools who were leaving too early. They were not. Stage 5 is revulsion. The crash completes. The losses are tallied. The fraud that was hidden by the rising prices is now exposed by the falling ones. Investigations begin. Bankruptcies are filed. The asset that everyone was certain would change the world is now treated with contempt. People who lost money swear they will never touch that asset again. And here is the part that makes the pattern so durable. The contempt is so total and the memory so painful that the asset itself becomes untouchable. Which means that when it slowly, quietly begins to recover, it does so unnoticed. A new generation of investors, too young to have been burned or simply far enough from the epicenter to have moved on, begins to pay attention. The displacement begins. Stage 1 reopens. The script restarts. Every bubble operates on the same engine. the gap between price and value, and the social pressure that prevents people from pointing it out. Bubbles are not primarily financial events. They are social events. They run on a fuel made of two parts human nature, the fear of missing what everyone else is gaining, and the desire to belong to the group that is right. Understanding a bubble while you are inside it is extraordinarily difficult. Not because the signs are hidden, they are almost always visible, in hindsight, as obvious as anything could be. It is difficult because the social cost of being early is high. To call a bubble while it is still inflating is to separate yourself from a crowd that is making money. Every day you are wrong about the timing, the crowd is right, and being right too early is indistinguishable in the moment from simply being wrong. The practical question is not whether you can spot a bubble, it is whether you can act on what you see before the crowd turns. The evidence suggests that very few people can, not because they lack intelligence, but because the same social wiring that makes humans extraordinarily good at cooperation makes them vulnerable to collective delusion. The wisdom of crowds works when individuals are making independent judgments. It fails catastrophically when everyone is watching everyone else. The 5-stage pattern does not tell you exactly when to get out. It tells you which stage you are in, and that is not nothing. When the valuation methods change and the old measures are declared irrelevant, you are in stage 3. When everyone you know has made money and feels certain they will make more, you are in stage 3. When the argument for buying is that the price has been going up, you are in stage 3. You may be early, you may be very early, but you are not in stage 1 anymore. What Minsky understood and what most economists of his era refused to accept was that the financial system does not naturally tend towards stability. It tends towards cycles, and the cycles are not random. They have a shape, they have stages, they have, as he put it, a certain music. Learning to hear that music does not make you immune, but it makes you a little less likely to be dancing when the song ends. Tulip bulbs, railroad stocks, Florida real estate, .com companies, collateralized debt obligations, cryptocurrencies. The names will keep changing, the 5 stages will not. The next bubble is already in one of them right now. The question is only which one. Thanks for watching Early Birds Invest. If you enjoyed the story, subscribe for more animated videos about money, business, and investing. And remember, stay curious, stay early. I'll see you in the next one.